Welcome to the ETF show, taped right here at the New York Stock Exchange. I'm your host, Kristen Myers, ETF editor-in-chief at Asset TV. Now, aging infrastructure is costing Americans thousands of dollars a year, with climate change exacerbating the risks and costs of infrastructure failures. Now, the need to invest in infrastructure resilience and transition to a more sustainable economy provides an investment opportunity. Here to discuss more is Harry Boyle, portfolio manager of Impacts Asset Management, which recently converted their mutual fund to an ETF. That's going to be ticker BLDX, the Impacts Global Sustainable Infrastructure ETF. Harry, thank you so much for joining us today.
Kristen, thanks for having me.
So first, I want to start on that conversion. Why was now the right time to go from the mutual fund to an ETF?
I think the tax environment is changing. It felt like we knew our shareholder base very, very well. So we felt that we could educate them, get them on board, and show them the benefits. And I think, that is the direction of travel for what we do. We think more active ETFs will come along. It felt achievable to bring our clients with us, and they've been happy to participate.
Now, when it comes to the strategy, has anything changed in moving it over to the ETF wrapper?
Nothing. Yeah, what we set out to do is provide our clients with a very kind of stable, defensive return, and how we define sustainable infrastructure remains exactly the same.
Okay, so you've mentioned two things that I'm definitely going to be picking up on a little bit later. One, the defensiveness, and then two, what sustainability actually means. But I want to ask you about what infrastructure actually means, because it used to be that when you thought of infrastructure investing, you really just thought of, roads and bridges and utilities. And that set has really seemed to broaden now over time. Can you kind of explain that and explain the evolution of the opportunity set that we're seeing now?
Absolutely, and you're spot on. I think they used to kind of cut it into different tiers. There was kind of core infrastructure, and then there was sub-core. And I think you're right. The definition has evolved. It's no longer just about toll roads and bridges. I think particularly the obvious one is digital related infrastructure, whether it's telecommunication networks or the kind of tower infrastructure that support that. And then within our definition, we've also tried to look at EV charging, electric vehicle charging systems. We've thought about healthcare. As we get older as a global population, we're going to need more hospitals, more senior living. So for us, I think that wouldn't have fitted into a traditional infrastructure definition, but for us, those are legitimate infrastructure investments.
Now, you've mentioned a few things. Are there, or what are rather, some of the biggest drivers of infrastructure investing now as you're seeing it? Are there, certain themes or pillars really that are standing out the most?
Yeah, I think that there are five for me. One is moving electricity about. That's kind of theme number one. Number two is kind of social infrastructure. That talks to social housing a bit. Number three is the generation of electricity, because we are going to electrify more and more. Number four is kind of digital communications. And number five is kind of water consumption, resilience, using water more efficiently. Those are five enormous deals that don't get solved in 5-year horizons. They get solved in 25-year horizons, basically.
Now, I have to ask, how does AI really fit into infrastructure right now? It is one of the biggest themes that we are seeing at the moment.
Yeah, it's the beating heartbeat at the moment. Yeah, so it really is. Where is the big constraint around building out these data centers and continuing to move forward with this technology? It is in the power going into the data center, but also the water supply. I think in the United States, you're on the front line there. Water consumption is incredibly important. And I think, at Impacts, we've always felt that it's a finite resource. You have to manage it very, very carefully.
Now, some would say at the beginning, I don't know where you think we are right now in this sort of AI revolution. But I'm curious to know what parts of the infrastructure ecosystem are going to be benefiting the most as we see more and more AI adoption.
Uh, that's a good question. I think the kind of the winning companies are probably going to be providing some sort of product or device into the data center, and then you've got some very complex, exciting technologies, whether it's to help reduce the heat within the data center or make sure that the water consumption is that much more exacting. It's perfectly circular, i.e. you're not constantly pulling from a river or the local domestic supply, and you're using less electricity, using less water. So there are huge efficiency pushes, but also building what we call the kind of grid system that supplies the power into the data center. It's very boring. It's wires, it's poles, it's substations. Very, very important. Big opportunity.
Now, as I mentioned, I said I was going to pick back up on something that you mentioned earlier. And so I want to start with sustainable and sustainability. What does a sustainable economy mean as far as impacts is seeing it, and what opportunity comes from this transition to a more sustainable economy?
Yeah, I think it's definitely been dialed back in the last 2 to 3 years. But for impacts, it's not about a perfect company. It's about a company that is very profitable, a good business on its own, that is moving us towards hopefully emitting less carbon. And within the context of infrastructure, that's the big thing that we focus on. Our companies are not perfect. Some of them consume fossil fuels. None of them would produce fossil fuels, but we have to see a line of sight to them weaning themselves off that. And again, it's not going to happen in 2 to 3 years' time, but we need to know that it's going to happen in 15 years' time.
So decarbonization, which I think was actually a phrase that you guys either came up with or used.
That's it, exactly. It's decarbonizing infrastructure. So if they go backwards, they suddenly start burning a little bit more gas rather than burning less gas year over year. We will be on them and saying, what's happening? Because when we last checked in with your plan, that was not part of it.
Right.
And that's hopefully our duty to our investors to make sure that those companies are continuing to move forward.
So talk to me a little bit more about, as you see it, the investment opportunity then that's coming from that kind of transitioning or decarbonization, that line of sight, as you were just mentioning, that these companies are going to have, as you were saying, not 5 years, not 10, but 20, 50 years down the road towards producing less and less carbon.
Yeah, I think the opportunity, thankfully, is there because the big tech providers and the Magnificent Seven or the Magnificent 10 don't appear to be backing away from their plans to decarbonize. So that drives the whole system. All of this, 600 billion, 700 billion of kind of free cash flow going into the AI capex is supported by strong governance that says, look, we want to move towards having less and less gas going into the electricity supply that feeds our data centers. So yeah, credit to big tech. They are at present. It appears like they're holding the line and they're continuing on that decarbonisation path themselves.
So I think when a lot of folks might hear about BLDX and they hear you talk about sustainability, I think ESG starts flashing, in the minds of a lot of advisors and in the minds of a lot of investors. Is that how you're seeing it and how you're seeing this fund under the umbrella of ESG? And if not, is there some sort of misconception around ESG that you think makes folks really lose out on some opportunities?
It's a very good question and like a very pertinent question. I think I would say ESG has never been what we do. The G bit, the governance bit, is incredibly important to picking good stocks. It's that simple. And so we've kind of reframed it and thought of it more about kind of corporate resilience. and we look at the environmental and social impact. But because we're trying to invest around decarbonising infrastructure or sustainable infrastructure, we tend to look at a set of companies that are pretty good. They're already at a high level in terms of the E and the S bit. So it is about us doing that corporate resilience analysis or governance analysis and gaining greater confidence from.
Now, at the start of this, I sort of mentioned that at least here in the United States, I think no one watching will be unfamiliar with the fact that our infrastructure is crumbling, to put it mildly, in a lot of areas. So where are you seeing, either not just in the US, but on a global scale, some of the biggest capital needs?
Yeah, and if it's any consolation, it's the same in the UK. Anyone you speak to will have complaints about the UK's infrastructure. But I think if there's a wall of money coming into infrastructure investing, and there's studies out there that say we need to spend about 7 trillion each year to regenerate our global infrastructure footprint, I would say roughly 60%, maybe 2/3 will be in Asia. So we'll do a lot of spending, and it'll be more about restoration and kind of replenishing assets in the Western world. But the new build, the massive new build, will probably be in Asia. But it won't be so focused on data centers. It will be everything,
Right.
the whole gamut. So yeah, the big build over the next 20 years will be in Asia.
Now, how much of the investing cycle is really driven by, some of these environmental goals that we've all heard of, and how much of it is by this ever increasing demand for more and more energy?
Yeah, I think I've been in and around the space for 20 years. I think it's now an extremely exciting moment whereby these stocks or these companies start to divorce themselves from the policy. The policy was needed to help us put us on a path to decarbonising, but now we're at the stage where solar alone, it's not reliable. It's not without a battery, but it's definitely the cheapest form of producing a unit of electricity. It's only going to get cheaper. Batteries are only going to get cheaper. So if they can do constant power, then you almost all the other technologies we're not far away from will be less. They won't be in such great demand. So, and that's a very positive trajectory to be on. So the system without policy support is essentially decarbonising now. The snowball has started, and it's gathering enough pace.
Now, obviously, if we talk about the global infrastructure story, we do have to talk a little bit about geopolitics. And so how much of the infrastructure story today, is really about energy security and reshoring and supply chain resilience? That's been a very big one over the last couple of years.
Yeah, I think what I've seen that's most interesting is that, electric vehicle adoption in China, Norway, Singapore, places like that was already, I think you would say in America, mid-innings. But what those Asian economies are so vulnerable to oil-related supply shocks and gas-related supply shocks, that EV adoption has really accelerated in 3 months or in 2 months. And now, nothing is going to sharpen their minds of both the consumer and the government that I don't want to be dependent on an energy source coming out of the Middle East more than this crisis. So I think, electrification may have taken a bit of a backseat in North America and also a little bit in Europe, but it is really accelerating in Asia and countries like, Taiwan, as I said, Singapore, China, Hong Kong. It's coming up the steep part of the S curve, basically.
And so say more, because is that changing the capital deployment that we're sort of seeing as a lot of these countries are moving towards, as you're mentioning, essentially self-sufficiency?
Yeah, I think. I think it is. Yeah, yeah. The EV charging, I think, needs to make improvements. Having thousands of apps on your phone, and you go to a marginally different supplier, so can simplifying the process of just getting electricity in your car. I think is advancing fast in Asia, and also in Europe. Um, so I think, yeah, capital deployment. Yeah, I think governments are again looking at renewables, but they're not saying we're going to incentivize renewables. Exactly to your point, they're saying it's about energy security and resilience. We're going to incentivize energy security and resilience, so we are less dependent on these supply shocks.
So, in terms of infrastructure inside of a portfolio, you mentioned defensive earlier, but I'm curious, given the fact that AI and infrastructure are now being so closely tied, I wouldn't think of AI as a defensive play at all inside of a portfolio. So, is it still a defensive allocation infrastructure?
That's exactly. I think that's key. I think it's about very good point. Having a measured amount of exposure to the AI capex story. It's extremely exciting. There's a lot of money pouring into it. You're seeing some stocks do incredibly well. Within the context of what we're trying to do, we want a bit of exposure to that. We want to make sure we're in the slightly more boring parts of the value chain that are genuinely defensive. So if it ever cools off, we're still left with a great business that's super profitable, and it may not grow at 40%, but it'll grow at, between 10 and 20%, and we're fine with that.
So then where does infrastructure, as you see it, sit in a portfolio alongside, fixed income and equities?
Well, yeah, the first thing I would say is that there are kind of fixed income like properties to some of the businesses that we invest in. Quite a lot of the portfolio is in regulated utilities and telcos, and they tend not to grow their revenues at kind of AI company levels. So they'll, I would say, kind of high single digit, but they pay a dividend yield of between 3 and 5%, and a lot of their contracts tend to have inflation pass-through baked into them. So they are, they are very much like fixed
Investors
income
will love
products.
that.
Yeah, fingers crossed. Yeah. And then we try and supplement that with really exciting, slightly more growthy infrastructure businesses that are maybe playing into other parts of the value chain. And it's incredibly important to stay diversified across our kind of slightly narrow field. So we have kind of 4 or 5 big sectors that we invest in. We can't go to all 11 gig sectors, but we're focused on trying to stay diversified. And as a result, I would say, yeah, it's a bit like a kind of fixed income equity mix product.
Are you seeing infrastructure as a thematic holding in a portfolio, or are you really thinking about it more as core?
I'd like to see it as core. Yeah. And when when asset allocators need to dial up defensiveness, allocate a bit more to us. And if markets are going crazy, then maybe you dial us down for a moment. But
Right.
we would be a very useful tool or kind of knob to turn at certain moments.
So for the last question, I want to ask you to be a bit of a fortune teller and pull out your crystal ball. I'm curious, maybe not 5 years, maybe not 10 years, it might be longer than that. But in 10, 20 plus years time from now, do you think that there's going to be an investment opportunity or an infrastructure opportunity, I really should say, that an investor in the future might say, oh, I really wish I paid more attention to it now in 2026?
That's a great question. My inclination is always to go for the kind of the boring picks and shovels part. Like as I said, the wires that move electricity around and the substations that you probably see as you drive down the highway, they are, the businesses that do that are probably in clusters of 4 or 5. They're great businesses. They're super profitable. What they do will be in very high demand for a long time. It's not very exciting, but I imagine they will make good profits for a long period of time.
Well, it doesn't have to be exciting to be a good investment opportunity. Harry Boyle, Portfolio Manager of Impacts Asset Management, thank you so much for joining us today. And thank you for tuning in to the ETF show.